It's Friday. We're feeling good. We should be ready for the weekend. I hope you've got something awesome planned and just get away from the markets and enjoy what life is all about, right? What investing is all about. I'm going to talk about the markets a little bit today, but most importantly, I want to focus on two ETFs. I talk a lot about individual stocks on this channel, but I want to talk to you about two ETFs that I would own if I owned ETFs, and the ones that I recommend my friends and family members own if they want exposure to the stock market. And then, of course, as always, I'll go into an update of my portfolio and how we ended the week. And so here we go. Just early afternoon, it looks like the Dow's down a little bit, S&P 500 is down a little bit, and the NASDAQ is up 1.3% with the Russell 2K up 1%. This is what I think is going to happen over the next, few years. We're going to go back to normal where, in my opinion, great companies and fast-growing companies, now that things have kind of reset and these crazy valuations have reset, fast-growing companies, tech companies, are going to continue to lead the way and take the lead. I don't know what's going to happen over the short term, but I think that's what's going to happen over the long term, and maybe we're seeing that a little bit with the NASDAQ and Russell 2K, outperforming the Dow and the S&P 500. Two ETFs I want to talk to you about. The Schwab U.S. Dividend Equity ETF, SCHD, that's an ETF I would tell my friends and family, or I would own myself if I wanted something a little bit more conservative and wanted some dividend income. So that's potentially something I would be a little bit closer to retirement. I would want to just generate passive income and be more in wealth preservation mode than wealth growth mode, although wealth has grown in that, and it's a little bit riskier than your standard retirement type of investments. So by no means am I saying that, but that's how I think about that compared especially to the types of stocks I own right now. And then we've got the Vanguard Growth ETF, VUG. And so right here, just going to show you, this is over the last 10 years. They've each returned about the same at this point. Orange is VUG, the growth ETF. Purple is SCHD. And you could see 258 to 245 with the growth ETF leading. But if you see, prior to this sell-off, it was way up there, doing way better with a 450% return compared to a 300% return from SCHD. What does that look like in real money terms? Well, if you would have put $10,000 into both of these in 2012, you'd be sitting at $35,000 and $34,000. Not too shabby. The VUG investors probably kind of feeling sad right now because they were at $54,000, but that has since shrank to $35,000. And so that's kind of lesson number one with these, is that one is obviously much more volatile than the other. And that's a lesson with investing too, right? Like, they've both performed pretty much equally as well, but I would bet the VUG investor is feeling a lot worse right now than the SCHD investor, even though by the, through the journey, they're at the same point. And so that's an interesting concept about kind of the pain of losses being 3 times worse than the joy of gains in financial terms. Let's jump into each of these ETFs though and give you a feel for the differences between the two. And this is Morningstar. This is their investor product. I pay for it. It's the Schwab U.S. Dividend Equity ETF. It gets a 5-star silver rating, which is kind of weird because the VUG is gold, but it only gets 4 stars, so I'm not sure what the difference is there. It's got a yield of 3.1%. Risk is something that every investor needs to be aware of and think about, what risk means to them and is appropriate for them. So compared to the category, Morningstar says that SCHD has below average risk, and then the return versus category is high. And so that's great. If you're looking for an investment in that category, in the dividend type category, below average risk and high return is a great combination. If we look at these terms here, risk and volatility measures, we're really focused on alpha and beta. And for quick descriptions, alpha measures the difference between an investment's expected return based on its beta and its actual returns. A positive alpha indicates the investment has performed better than its beta would predict. A negative alpha indicates an investment has underperformed given the investment's beta. So we got to know what beta means. Beta measures an investment's sensitivity to market movements. A beta greater than 1 indicates the investment is more volatile than the market. If the beta is less than 1, the investment is less risky than the market. So what this is telling us about SCHD is that it's got a beta of 0.9, which means it's less volatile than the market. It moves less than the market, but its alpha is 4.92. And remember, if alpha is positive, that's a good thing. That means its returns are good considering its beta or its volatility to the market. So we like these two scores with SCHD. Another huge thing to consider with funds or any investment really is maximum drawdown. And this is where we get into how comfortable we might be owning a particular investment. And we can only know with ourselves. But SCHD's maximum drawdown was 21.5% compared to its category. The category drawdown was almost 27%, so it beats the category. And the index was almost 25%, beats the index. Peak drawdown was actually through COVID, which makes sense because SCHD owns a lot of dividend-paying stocks, kind of some industrial type things, and those were the ones that got hit really bad in COVID. So the peak for this was January 1st, 2020, and then the drawdown valley, so the lowest part, was March 31, 2020. So that's 3 months. Other thing we have to consider is cost, right? So this just illustrates a 10K investment with 5% return. It's got a net expense ratio of 0.06, which is very low. There are some you can find lower, but still pretty good. Anything less than 0.1% is pretty good. So in 10 years, if you started with 10K and made 5% per year, you would only have paid $77 in fees, which is pretty darn good. Here we can see that the price to earnings ratio on average for this fund is 13.59. When we look at the next one, it'll probably be a little bit higher, so we'll see about that. And the dividend yield is 3.4%. Finally, let's get to holdings. So this fund has 100 holdings. 41% of the assets are in the top 10 holdings, so relatively concentrated, but not too concentrated. And then 46% turnover, which feels kind of high, but that's because they've got some pretty stringent dividend requirements that force them to kind of sell things if they fall out of their requirements. And so the top position right now is Merck at about 4.6%, IBM at 4.35%. And this personally is why right now I don't own funds, is because it's hard for me to find a fund with companies that I want to own, and that's why I would rather pick individual stocks. So for example, I don't know that I would ever own IBM, but it's in this fund and I still like this fund. So that's kind of why I choose to do individual stocks while I have the time and I pay attention to it. But this fund performs great. So IBM's dividend's probably pretty strong, and that's why it's in this fund. Amgen, 4%, Coca-Cola, 4.2%, Pepsi, 4.2%, Pfizer, Verizon, Texas Instruments, Broadcom, and Home Depot. Let's look at one more page, and then we'll jump over to VUG. Lockheed Martin, Cisco Systems, Automatic Data Processing, BlackRock, Altria Group, 3M, EOG, U.S. Bank Corp, Illinois Toolworks, and Valero Energy Corp. Pretty solid fund all around. Let's jump over to VUG. Okay, starting right off the bat, the expense ratio is 0.04%, which was lower than SCHD. It's got $64 billion in assets, and it is a U.S. large growth fund. The yield is only 0.5%, so much lower than the yield of SCHD. Okay, and this is where we're already starting to see a difference in the types and especially the experience of an investor in these two funds. Alpha for this is minus 0.12 and beta is 1.10. And the max drawdown of this investment was 24%, a little bit higher than SCHD, with that drawdown actually happening this year. And that's the difference between it tells you the difference between the types of stocks in these two funds. I can guarantee you, I mean, it's a growth fund as well, but that this is more invested in tech and SCHD is more industrial and dividend, just based on the periods of those drawdowns of what's happened in the market. So anyways, January 1st, 2022 to May 31st, 2022. So that's been a 5-month drawdown. And then fee is going to be about the same, $51 over 10 years if you had a 10K investment. And this is where we'll get in. The price to earnings ratio is 23, which is higher than the price to earnings ratio in SCHD. And the dividend yield is obviously lower. And let's jump to the stocks, right? So this is where funds can be great for investors if they want exposure to companies that they like. They're willing to, own some companies in the fund that they may not be great fans of, but they would just rather have the convenience of somebody else managing it and less risk, essentially. Percent of assets in the top 10 holdings is 49, which was about 5% more than SCHD, with only 8% turnover. So that's a big difference there because they're essentially just tracking something like the S&P 500. And the top position is Apple at almost 12.8%. So if you notice, that's much larger than the largest position, which was under 5% in SCHD. Microsoft at 11.3, Amazon at 5.7, Alphabet at 3.8, Tesla at 3.5, Alphabet again at 3.4. So Alphabet's really like a 7% position. That's just different share classes. Facebook or Meta at 2.4, Nvidia at 2.4, Visa at 1.8, and Home Depot at 1.75. And then rounding out the top, I think 20, MasterCard, Thermo Fisher, Costco, Walt Disney, Accenture, Adobe, McDonald's, AMD, and Linde. And so let me know in the comments, I mean, which one of these are you a fan of? Which one would you be more likely to own, or maybe you do own? Are you going tech? You going tech growth, VUG, or are you going dividend and a little bit more sustainable and stable SCHD? And you know me, these videos can't be complete without me sharing my portfolio, because that's what I want to do. I run a portfolio of growth stocks. I talk about them all the time, and I want you to know how my performance is. I hope nobody just blindly copies. That's not the point of this. It's if I'm sharing information and talking about stocks, I want to show the portfolio that I'm building and what the performance is over time. So we're at 54,342, having a good day, almost $2,000 on the day. I mean, we've lost a lot of money here recently, but how cool does that feel to do nothing? I've done nothing with this portfolio today, and it's up $2,000. I mean, just incredible, right? And then I can focus my life on working, spending time with family. We're going camping this weekend. It's going to be awesome. Hope you have fun this weekend. And just things that I want to do in life, right? And then grow this portfolio. And that's why I don't day trade. People day trade, and that's fine. That's great. But I want to invest for the long term. Anyways, up 3.7% today. And sure, having a great day. But long term, since we started this again February 15th, 2022, we are still down. We're down $16,000. We've put $70,000 in. And if we want to think about making up that $16,000, we need to earn about 30% from here to get back to even. But I'm going to continue to add money. I add money every month, and so it's not quite that bad, because as I add money, we won't have to go up as much to make up that $16,000 in percentage-wise, unless the market in my portfolio keeps going down, then we will. But here's what I own, hasn't changed. Crowdstrike, Snowflake, Datadog, Gitlab, The Trade Desk, Rocket Lab, Tesla, MongoDB, and Cloudflare. If you like this content, would love for you to just like the video. It helps more people find it and tells me if I should make more of these. And then subscribe to the channel and share it with friends. Have a great one.